Good morning, everyone, and thank you for joining us today for this webinar on LIBOR Reform Phase 2 with BDO. My name is Jeremy Palmer, Head of Financial Policy at the BSA. I'm joined by Mark Spencer, Accounting Advisory Leader at BDO, who is going to do the really hard work of presenting, and very importantly, behind the scenes, also by Lauren Hughes, Business Development and Marketing Manager at BDO, who is in control of the technology today. Also in the background, we'll have Ariel Grossberg, who's the audit partner at BDO for a number of society clients. And as for me, I'm just the warm-up act. The first thing I wanted to say from all at the BSA and BDO is that we hope you and your respective teams and families and contacts are all safe and well during this difficult time. Secondly, a big welcome to the BDO team, as I think this is their first official event as a BDO associate. We're delighted to have such a large turnout from members, plus a couple of invited associates from Almis and King & Shaxson, who are of course well known to you. Now, I wanted to touch on some housekeeping points. I don't need to tell you where the fire exits, refreshments and toilets are, as we do in a physical seminar. You look after that yourself, but some key points for a webinar. Today's webinar is going to be recorded, and we'll circulate the slides and recording in the coming days. Your lines will be automatically muted throughout the webinar, so please submit your questions to the panel throughout the session using the Q&A box on the bottom right-hand side of the screen. Please ensure you send the questions to all panelists. We'll try to cover as many of these as we can at the end of the webinar. If you have any problems with the sound or other aspects of the tech, please let us know via the Q&A box. With that, I think all I have to do is shut up or mute myself and hand over to Mark.
Jeremy, thanks. Good morning, everybody. I am Mark Spencer, and I lead our Financial Services Accounting Advisory practice at BDO. First of all, a huge thank you from me and Ariel, Lauren and team for joining us today for this webinar. Financial Services Accounting Advisory at BDO spans all aspects of accounting and financial reporting across 5 pillars: accounting change, structuring advice, financial instruments accounting and reporting, climate and corporate reporting, and all other areas of accounting. One thing that the Financial Services Accounting Advisory team at BDO has been doing as interest rate benchmark reform progresses is engaging with financial reporting and prudential regulators in the UK and the EU, trade bodies, our peers, both locally and internationally, and other parts of the wider community on the accounting for the implications arising as a result of the reform under both international financial reporting standards and generally accepted accounting principles in the UK. And this engagement includes, obviously, with the Building Society Association and a number of building societies themselves. We have run webinars on the first phase of the accounting amendments for interest rate benchmark reform that focused on pre-replacement issues in 2019 and earlier this year. Today's webinar focuses on the second phase of proposed accounting amendments, that is to say, those that deal with replacement issues. In terms of agenda, for the time that we have today, we'll be providing some context on the current status in terms of standard setting, and then talk through the proposed amendments to existing accounting requirements that the International Accounting Standards Board and Financial Reporting Council are currently contemplating. This will be across modifications of financial instruments, hedge accounting, new financial instrument disclosures that will be required, other standards that are being amended, and also those areas of accounting that are not being amended. On hedge accounting, we will also be considering transition, given some of the proposed amendments are applicable for a period of time and only a period of time. And on those areas of accounting that are not being amended, we will provide some insight as to why. But first, what is the issue? Why are we here? And where are we? the ISB issued an exposure draft that focused on replacement issues on the 9th of April 2020 that had an accelerated comment period of 45 days. This comment period closed on the 25th of May 2020. The ISB board and its staff have been working very quickly, even through COVID-19, so as to introduce accounting change given the wide-ranging effect of InterBank Offered Rates, which are colloquially known as IBORs. Replacement issues are those that affect accounting and financial reporting at the time that the reform takes place. That is when an IBOR is replaced with an alternative risk-free rate. Examples of risk-free rates are SONIA, Esther, and SOFIA. The proposed amendments, which in the main provide relief from existing accounting requirements, span modifications of the contractual terms of financial assets and liabilities, hedge accounting, lease contracts, and disclosures, and their main current accounting requirements that arise as a direct consequence of interest rate benchmark reform. The amendments, when issued, will be effective from 1st January 2021. This is not 1st January 2020, as the ISB does not issue standards, amendments, and interpretations and make them applicable for reporting periods that have already commenced. Early application is encouraged, but the European Union does need to endorse these amendments once they have been issued. The UK is still bound by the need for EU endorsement of IFRS until the transition period ends with relation to Brexit. Furthermore, the amendments, when issued, can only be applied in IAS 34 interim financial reports once they have been endorsed by the EU. The amendments are mandatory for annual reporting periods beginning on or after 1st January 2021, and their application is retrospective when it comes to hedge accounting. We are expecting these amendments to be issued in August, so within the coming month. And the responses to the consultation, that is the exposure draft, were deliberated at the June ISB board meeting, and we will be sharing insights from changes to the proposed amendments as they were set out in the exposure draft in terms of how the ISB discussed them in June, and we'll also be highlighting the changes that the ISB has decided to make to the proposed amendments and in terms of what we're expecting to see when those amendments are formally issued sometime soon in August. I'm aware that a number of the Building Societies Association's members are applying UK GAAP, that is FRS 102. And under FRS 102, when it comes to financial instruments accounting, one can either apply the recognition and measurement requirements of sections 11 and 12 of FRS 102, or those of IAS 39, financial instruments recognition and measurement, or IFRS 9, financial instruments. The Financial Reporting Council issued an exposure draft which is broadly similar to that of the ISB in May of this year. The comment period for this is still open. It is open until the 30th of September 2020. The FRC's proposed amendments to sections 11 and 12 will only apply to those entities that are applying those sections. It will not apply to those that are applying IAS 39 or IFRS 9. The ISB's proposed amendments will apply to those that are applying the recognition and measurement requirements of IAS 39 or IFRS 9 to the accounting for financial instruments under FRS 102. The FRC's proposed amendments to the other sections of UK GAAP will apply for FRS 102 preparers, not those of the ISB. I strongly advise you to read the FRC's exposure draft to the extent that you have not done so already. Remember, this is Fred 74, and submit a comment letter to the FRC if you are a UK GAAP preparer. This is available on the FRC's website, and it is available for free. And as I said, the FRC's proposed amendments are broadly similar to those of the ISB, so what we are going to talk through during this presentation is equally valid for UK GAAP preparers, regardless of how they account for financial instruments. And I think this is particularly relevant for the Building Society because I'm aware that a number of preparers apply UK GAAP, but they opt to apply IAS 39 when it comes to financial instruments. And at that point, I'll take a pause here to see if we've got any questions from the audience. We'll be taking pauses throughout this webinar, but we'll also have time for Q&A at the end. Jeremy, do we have any questions, please?
Mark, I just have one sort of immediate thing to just jump in quickly. In fact, two immediate things. The first is something that came up in my own mind. It sounds as though, with what you've just been talking about from the standard setters internationally, that things have started to move on from the stage where everyone was waiting for something to happen. Sorry, that's kind of layman's language. Is that about right? Is there now a clearer agreement about what's supposed to happen in the accounting?
Yeah, I would say that there is. I mean, at the June board meeting, the ISB discussed the responses that had received the consultation, and it gave a view in terms of what it will be putting through in addition to what it proposed and what it will not be and why. And we'll be talking through this in this webinar. I mean, we do need to see the final amendment in terms of what they say, because it's very much down to what the words are. But we expect that to be issued very soon, sometime in August. And hopefully the EU will endorse it shortly after in September time. So I think we are reaching that point whereby whether we like the accounting or not, we will have clarity on what the accounting requires.
Yeah, okay, that's great. And the other thing, which is, again, a slight unpacking question, you've made reference to the direct consequences of interest rate benchmark reform, and this is obviously quite important. Can you just elaborate and unpack so everyone's clear exactly what we're talking about and what the scope is? Yes,
and the ISB and the FRC have been unanimous in terms of what the scope is. They issued that last year, and for them, interest rate benchmark reform means the market-wide reform of an interest rate benchmark, including the replacement of an interest rate benchmark with an alternative benchmark rate, such as those resulting from the recommendations that were set out in the July 2014 Financial Stability Board report that was called Reforming Major Interest Rate Benchmarks. So GBP LIBOR to SONIA is an example of what is captured, as is USD LIBOR to SOFR and Euribor to ESTR. They're all captured and within scope of the proposed amendment. The Bank of England's base rate or the Federal Reserve base rate are not captured by these proposed amendments. And this means that IFRS's and UK GAP's current requirements for such latter rates apply as they currently stand. And just to also link this to Jeremy's first question, the amendments that have been issued are there to provide relief, because the ISB and the FRC believe that accounting should not be distorted unduly because of interest rate benchmark reform. And we will talk through that relief, such as it does not give rise to discontinuance of hedge accounting when you update your hedge accounting designation documentation to say SOFR instead of LIBOR. So it's relief from current accounting requirements. It's not onerous in terms of it doesn't introduce new accounting requirements. That sounds really good. So again, trying to interpret that in my very simple terms, it sounds as though the accounting tail is no longer going to wag the LIBOR reform dog. Well, I don't necessarily think the accounting tail has always been wagging the commercial dog, but I do agree that we have more clarity now than we did earlier this year, for example. Okay, that's cool. Look, I'll shut up and mute myself, and I'll let you continue, Mark. Thanks very much. That's perfectly fine, Jeremy. Thank you. Okay, so moving on to modifications of financial instruments. At the moment, without the proposed amendment, when faced with a change to a contract underlying a financial instrument, one needs to assess whether this modification is substantial or not in both qualitative and quantitative terms. A modification is typically substantial when the carrying amount under the new terms is 10%, more or less, than the carrying amount under the original terms. A modification is typically substantial in qualitative terms in light of the type of change or changes. If substantial, one de-recognizes the original financial instrument and recognizes a new financial instrument, with the difference being recognized in profit or loss. This proposed amendment is a relief from this test, whereby if and only if the changes are a direct consequence of interest rate benchmark reform, then this test does not apply. So I'm really glad that Jeremy pointed that out earlier. So you would apply this relief if you're updating a financial instrument from GBP LIBOR to SONIA, but you would not apply this relief if you're updating that from GBP LIBOR to the Bank of England's base rate, for example. The proposed amendments also clarify that this relief includes the activation of a clause in the terms of a contract, such as a fallback provision. And it also includes changes to the basis on which the interest benchmark rate is determined, which should arise with respect to SONIA later on this year. This last point is as long as the change in basis is economically equivalent, that is to say, there is no value transfer. So, to go back to the point that me and Jeremy were debating a few minutes ago, this is providing clarity in the sense that these amendments incorporate the insertion of fallback clauses and the activation of those fallback clauses. They also incorporate, and the relief applies to instances, if the basis on which the alternative risk-free rate determined changes. Those would be incorporated and captured by this relief. So, what are the direct consequences of interest rate benchmark reform? These are outlined on your screen and include, quite simply, replacing the word LIBOR with SONIA. And as stated a minute ago, changes to the basis on which interest benchmark rates are determined also constitutes a direct consequence of the reform, as is adding a spread. And this is because IBORs are typically at a higher rate than alternative risk-free rates, as they contain an element of credit spread, credit risk, that banks factor in to what they would lend each other at. Therefore, the proposed amendments allow for moving from LIBOR plus 2% to SONIA plus 3% if the difference between LIBOR and SONIA is 1%. Also, changes to reset periods and dates, as well as number of days between payment dates that are driven as a result of interest rate benchmark reform, are considered to be a direct consequence, as is, as I said earlier, the adding of fallback provisions to reflect any of these aspects. So, the proposed amendments allow for the application of relief whereby any of these are being inserted into the contract, whereby the change is treated as if it were a change in a floating rate of interest. Changes in floating rates of interest give rise to a change in the interest rate and an equal change to the cash flows. So that's to say the interest rate goes down by 1%, the cash flows go equally down by 1%, you discount those lower cash flows with a lower discount rate, the net impact on P&L is nil, there is no change in the carrying amount. If more changes are effected to the contract underlying a financial instrument, then those that arise as a direct consequence of interest rate benchmark reform are assessed first, and then you apply the requirements of IFRS 9 on recognition and derecognition to those other amendments. So, for example, you may also be extending the term of the loan, you may be increasing the spread further as a result at the request of the borrower. First, you would apply the relief to those changes that are a direct consequence of interest rate benchmark reform, and then you would apply IFRS 9's normal requirements for recognition and derecognition to the rest. This will also apply to IAS 39's requirements on recognition and derecognition for UK GAAP preparers by virtue of the FRC's proposed amendments, and it will also apply within the context of FRS 1 and 2. These are the proposed amendments on modifications of financial instruments as they stood in the exposure draft. At its June meeting, the ISB board tentatively decided to finalise these proposed amendments without substantial changes. So we are not expecting to see substantial changes in terms of what the ISB issues later on in the month of August. However, the ISB board also tentatively decided not to extend the proposed amendments to address issues that interest rate benchmark reform present in relation to IFRS 9's contractual cash flow test and derivatives embedded in financial instruments. IFRS 9 has a contractual cash flow test, which means that the repayments of the debt assets are solely payments of principal and interest, colloquially known as SPPI. Interest is defined as being compensation for time value of money and credit risk under IFRS 9, and this only applies to IFRS preparers and only applies to those UK GAAP preparers who have elected to apply the recognition and measurement requirements of IFRS 9 under FRS 102. IFRS 9 also has a concept known as modified time value of money, whereby the interest resets periodically to an interest rate that has a tenor that is different to the interest reset period. For example, interest resets monthly to 3-month LIBOR. This is colloquially known as a constant maturity swap, which is a derivative that is embedded in the debt asset host. In such instances, one needs to assess 1-month LIBOR against 3-month LIBOR and determine if this difference is significant. If it is, then the contractual cash flow test is not passed, as it does not represent compensation for time value of money, but something else, and the debt asset is measured at fair value through profit or loss. Some alternative risk-free rates currently only reset on an overnight basis and or on a backward-looking basis. However, they may then not contractually reset daily, but monthly, quarterly, and so on and so forth. The likelihood of there being a difference is therefore higher, which is expected to result in more debt assets being measured at fair value through profit or loss. Remember, the ISB board has decided not to amend IFRS 9's requirements in this respect. And I said currently a few seconds ago, as regulators are currently in the process of establishing methodologies for forward-looking alternative risk-free rates. So this will become less of an issue in the not too distant future. And we'll just take another pause here to see if there are any questions from the audience.
Mark, thanks. There's just one quick, it's sort of, let me say it's a kind of my idiot question. How would the identification of and accounting for these modifications work in practice when those contractual modifications could include some that purely relate to interest rate benchmark reform and some that don't? You know, where it's a bit of a mixed bag. Anything you can say on that?
Yeah, happy to illustrate that point, and perhaps it'd be helpful if I give an example. So let's say that LIBOR plus 0.5% is modified to SONIA plus 0.5%, but that 0.5% is increased by 1% because of the difference between LIBOR and SONIA. So we're moving from GBP LIBOR plus 0.5% to SONIA plus 1.5%. At the same point in time, the borrower says to the lender, can we extend the term of the loan? Can we push it out a bit more? And can we reduce the monthly interest payments? To which the lender says, fine, but I'm going to charge you an additional 2% because of the increased credit risk and also because of receiving the cash later. And as we all well know, £1 in 2 years' time is worth less than £1 in a year's time, and it's worth less than £1 today. And so in practice, what it would work is you'd apply the proposed amendments, the relief, to the change from LIBOR plus 0.5% to SONIA plus 1.5%, and this would have no impact on the carrying amount. And then you would compute the new carrying amount using the extended term, the revised monthly interest payments, and you discount these using SONIA plus 1.5%, but you would ignore the further fixed spread of the 2%. So the first step is you'd apply the relief, you'd increase the interest rate to reflect the change. In this case, it's staying the same overall. You'd affect the change to the cash flows, no impact. You then compare that carrying amount with the extended term, the revised monthly interest payments, and you discount that new carrying amount using SONIA plus 1.5%, but you do not factor in the further fixed spread of 2%. And if you have a difference in terms of the carrying amount, this is more greater than 10%, then you would de-recognize the SONIA plus 1.5% loan, and you'd recognize a new SONIA plus 3.5% loan at fair value. Any difference is recognized in profit and loss. And I mean, what I've said applies to financial liabilities in IFRS 9, IAS 39, and FRS 102. And unlike financial liabilities, I'd just like to point out that UK GAAP and IFRS are not as prescriptive. However, we do apply, by analogy, the requirements for modifications of financial liabilities to financial assets.
Okay, thanks, Mark. There's also one question come up from a highly experienced and highly commercial practitioner in the audience. So I think it's kind of related to the previous question, but it's a much more specific issue. Does economically equivalent allow for banks or building societies charging a fee or embedding a fee in the SONIA spread to compensate them for their work in administering the transition? Does that make sense to you?
Yeah, yes, it does.
Yeah.
And I'll just go back. I'll just go back to the previous slide.
Mm-hmm.
So, I mean, what we're talking about here is two aspects that come to mind. First of all, SONIA will be set using an established method, and the Bank of England is consulting on that process at the moment, and there being an administrator in place who would administer that methodology, and SONIA is basically set as per the market. And I know that there's a market for SONIA at the moment, and again, SONIA at the moment is set by that market. So a change in the method used to calculate that interest rate benchmark is moving from the current market, whereby there's trades of SONIA derivatives and swaps, to a method that would be administered by an agent appointed by the Bank of England. And that's the method that is applied. So that would be captured by the change. Then adding a fixed spread in terms of the lender versus the borrower to compensate for any difference would also be captured by these amendments. So if LIBOR is 2% and SONIA is 1.5, then that means you can adjust the 0.5% to you can pass that on to the borrower and you'd be captured by the amendments. Anything else is outside the scope of these amendments.
Okay.
So that means, I mean, very bluntly, I don't think that passing on these costs to the borrower will be captured by the amendments. But then again, having said that, it depends how much is being passed on, I mean, to individual borrowers.
Mm-hmm. Okay. So the summary might be good try, but probably not.
Well, again, I think it comes back to, I don't think it's directly captured. I mean, I mean, clearly then you need to think about the commerciality of it, because the borrower would not necessarily accept an increase in the interest rate beyond what SONIA is lower at than LIBOR.
Okay,
so
sure.
I don't think the borrower is going to just say, okay, I'll absorb this 1% increase in rates.
No. Bearing in mind, it's probably a different picture if you're talking like wholesale size commercial borrowers as against retail borrowers. So maybe sort of both difference of awareness and difference of significance of fairly small differences. Anyway, I'll let you move on, Mark, because we got a lot of stuff to cover. So hand back to you. I'll mute myself.
Thank you very much, Jeremy. Similar to the modification of financial instruments, hedge accounting can be changed given interest rate benchmark reform under the proposed amendments without giving rise to discontinuance. This applies to both designation and documentation. Practically, one can amend both once or twice, as the reform can be affected to the derivative before the hedged item and therefore the hedged risk. And the relief in terms of not discontinuing when amending hedge designation and documentation, again, only applies to those changes that are a direct consequence of the reform. There is also relief in terms of hedge effectiveness testing under IAS 39. Remember, under IFRS 9, one can still apply the hedge accounting requirements of IAS 39, and the ISB has allowed this until its dynamic risk management project is completed. And another thing to remember, you could be applying fair value hedge accounting to the interest rate exposure of a portfolio of financial instruments under IAS 39, which is colloquially known as a macro hedge, and designating all other hedge accounting relationships under IFRS 9. We will revisit hedge effectiveness testing under IAS 39 in a few minutes' time. The proposed amendments outline what happens for both cash flow hedge accounting relationships and fair value hedge accounting relationships at the point in time that the hedge designation and documentation is amended. For fair value hedges, the hedging instrument and/or hedged item are amended using the alternative risk-free rate, and the difference that arises is recognized in profit and loss. Entities will need the infrastructure and valuation capability to estimate the fair value using both IBORs and the alternative risk-free rate. For cash flow hedges, the reserve is remeasured based on the risk-free rate to the lower of the cumulative position on the hedging instrument, that is the derivative, and the cumulative change in the fair value of the hedged item. But amounts accumulated in this reserve are then deemed to be based on the alternative benchmark rate, that is to say, SONIA. This includes amounts accumulated in the reserve that have been previously discontinued but were not recycled to profit or loss because, for example, the hedging instrument expired or was sold, terminated, or exercised, but the forecast transaction is still expected to occur. This means that the reserve is reclassified to profit or loss when the forecast transaction occurs based on the alternative benchmark rate as opposed to the original benchmark rate that was LIBOR. And on group of hedged items, the proposed relief acknowledges that IBORs may transition to different risk-free rates at different times and allows for the requirements to be applied at a subgroup of items level vis-a-vis the hedged risk. So an example that comes to mind here is you may have a macro hedge that has hedges using 1 month LIBOR, 3 month LIBOR, 6 month LIBOR, which are different subgroups, and you apply the relief to those subgroups independently of each other because the uncertainty relating to them may be resolved more quickly for some aspects as opposed to others. For example, the more short tail of the curve the uncertainty may be resolved more quickly than the others. And as I said, remember, you can change your designation documentation in relation to the hedge risk when you amend the terms of the hedging instrument and or the hedged item. So if you're in a fair value hedge, then you would amend I would see you practically amending the hedged risk when you amend the terms of the hedging instrument. If you're in a cash flow hedge, I would practically see you doing that when you amend the latter of the hedging instrument and the underlying hedged item. There's also proposed relief for designation of risk component. This is when part of the interest rate is hedged, even though it is not contractually specified. Typically, these need to be separately identifiable at hedge designation and each measurement date, with each measurement date being at least each reporting date. With the relief, one can now assume that a separately identifiable requirement is met, provided there is expectation that it will be separately identifiable within a period of 24 months from the date the alternative benchmark rate is designated. One may ask, why 24 months? Is this not an arbitrary number? The reason for this is that we're now in August 2020, and benchmark rates need to be reformed by 31st December 2021, which is less than 18 months away. And if alternative benchmark rates do not satisfy the separate identifiable 24-month criteria due to a lack of liquidity, then they are discontinued. On hedge effectiveness testing, cumulative fair values are to be reset to 0 at the point of the reform. However, hedge ineffectiveness continues to be recognized and measured in falling profit or loss for both fair value and cash flow hedges. If the alternative benchmark rate makes the hedge ineffective because, say, the result of prospective effectiveness testing is outside of the IAS 39 AT125 corridor, then that hedge accounting relationship is discontinued. The proposed amendments are mandatory and retrospective with effect from 1st January 2021. Prior periods are not required to be restated under the proposed amendments to reflect their application, but they may be restated if and only if it is possible to do so without the use of hindsight. Doing so would mean that hedge accounting relationships that were previously discontinued solely due to changes directly required by interest rate benchmark reform are to be reinstated. If an entity does not restate prior periods, the entity shall recognize any difference between the previous carrying amount and the carrying amount at the beginning of the annual reporting period, that includes the initial application of these amendments in opening retained earnings as at the date of initial application, with the date of initial application being 1st January 2021 for 31st December year ends, when the amendments are not applied early. And the date of initial application will be 1st January 2020 or 31st December year end if the amendments were applied early. But remember, the ISB still needs to issue these amendments, which, as we've said, we're expecting soon, later on in August, and then the EU needs to endorse them before they can be applied early. A couple of closing notes that I'd like to make on this slide is the first about risk components. A non-contractual risk component is when you have a fixed rate instrument, but you know that when setting that fixed rate instrument, you're doing that knowing that part of it is in effect variable. So whilst it does not refer to a fixed rate instrument, you know that part of it is variable. And the other point that I would like to make in terms of the reform and why somebody potentially may update the benchmark rate when both the hedging instrument and the hedged item are changed, the cash flow hedge. The reason for that is you have the phase one relief, which applies to IBORs, but not to alternative risk-free rates, and that still applies as of now. At the June meeting, the ISB board tentatively decided to finalise these proposed amendments with some changes. These include examples of amendments arising as a result of the reform, which included portions of a designated hedged item, and that these changes had to be effective by the end of the reporting period, during which the uncertainty with respect to a specific element associated with the hedge accounting relationship has been resolved. So that's to say that in the given year that the uncertainty is resolved, you need to apply these amendments by the end of that reporting period. It has also been clarified by the ISB that the 24-month period for risk components applies to the alternative benchmark rate when designated, and that discontinued hedge accounting relationships are only reinstated if they were solely discontinued because of the reform and still met all hedge accounting qualifying criteria, with the 24-month period in this instance beginning from the amendment's date of initial application. Finally, on hedge accounting, the board clarified that the relief is still available as long as the hedging instrument is not derecognized and the outcome of the manner in which the derivative is changed is economically equivalent to modifying it to refer to the alternative benchmark rate. This is because it might be market practice to actually tear up the old derivative contract and replace it with a completely new one. So the ISB board wanted to cover this off such that this would not give rise to hedge discontinuance if doing so was economically equivalent to modifying the derivative contract to refer to the alternative benchmark rate. And I'll just take another short pause here to see if there's any questions from the audience. Jeremy.
Mark, yes, thanks very much. There's a very interesting point you just made about the, it might be okay if you're repapering rather than just modifying, and if it's economically equivalent, that's okay. Now the question just on this point where you talked about earlier changes to effectiveness testing. Now I appreciate there's a webinar on accounting and financial reporting, but just widening it for a moment, how could one theoretically do this effectiveness testing, and are there any methods that are known about but are prohibited? Anything you want to say on that?
Okay, four possible schools of thought on that we have deliberated both internally and externally. The first is you mirror the change in the hedging instrument in the hypothetical derivative when you move from LIBOR to SONIA, remembering that the hypothetical represents the perfect hedge of the hedged risk in the hedged item, and then the difference in the hedging instrument and the hypothetical will be equal and opposite to the same amount and therefore offset, and there's no impact on hedge effectiveness, and there will be no recognition or measurement of ineffectiveness as a result of this. Secondly, one could restrike the hedged risk in hypothetical using the alternative risk-free rate, and this would give rise to a difference that is recognized in profit and loss because you are changing that rate at a point in time. Also, you could change the fair value of the hypothetical so there is no overall movement in the change in the fair value, but because of that, the hedge rate would change as a result, because you're passing on the full fair value change, but the components thereof, as you then measure it on a go-forward basis, will fluctuate as SONIA fluctuates. So you'll be recognizing ineffectiveness in profit and loss as a result of that. And fourthly, from a more purist perspective, one could theoretically go back in time and say, what happens if my hypothetical derivative was always a SONIA-based derivative? I mean, this is operationally complex, and I mean, I wouldn't be expecting somebody to be applying this in practice. I mean, to me, the first method, assuming nothing has happened, is less principles-based and not necessarily reflective of economic substance. So I don't think that would be in the spirit of accounting requirements. I mean, theoretically, the fourth way could be used to prove the first way for a sample of derivatives, but I would expect market participants to either be restriking using the change in rate, for which there would be an impact, or passing on the fair value change, which means that there would also be an impact as well.
Okay, great. Thanks, Mark. Sorry, I'll leave you in peace now to go on with your next slide. Cheers.
Thank you, Jeremy. A couple of points on new disclosures that relate to financial instruments. Firstly, these include disclosing the nature and extent of risks associated with the reform, how the entity is managing them, how the entity is progressing vis-a-vis transitioning to alternative benchmark rates, and how that transition is being managed. At its June meeting, the ISB board tentatively decided to finalize these with one clarification, with this clarification being my second point, being that an entity is required to separately disclose quantitative information about non-derivative financial assets, non-derivative financial liabilities, and derivatives separately that at the end of the reporting period remain referenced to an IBOR. This is to be disaggregated by significant benchmark rate, for example, GBP LIBOR, USD LIBOR, and Euribor, and the entities to choose and explain the representative basis on which that quantitative information is being disclosed. In terms of other proposed amendments, the ISB is amending one area that may be of particular relevance. This is to IFRS 16 leases, which has similar modification requirements to IFRS 9. Lease rental payments may be linked to an interest rate benchmark. In such instances, similar to financial instruments, direct consequences of the reform are again treated as if it were a change in a floating rate of interest, whereby the discount rate is changed, as are the cash flows, with no change in the carrying amount of the lease. The FRC is proposing broadly similar amendment in FED 74. And in June, the ISB board tentatively decided to finalize the area of proposed amendments without substantial changes. Moving on to areas that the ISB has decided not to amend, and more importantly, provide some insight as to why. Firstly, no amendments have been made to requirements relating to changes in discount rate and to use to determine other accounting estimates. This is because that such would constitute a change in accounting estimates under IAS 8 accounting policies, changing accounting estimates and errors, with the change in accounting estimates being accounted for prospectively. So there's no real impact of the reform as a result. It's just accounted for as a prospective change. This may give rise to a one-off impact on profit and loss or a more long-term one, such as when estimating value used for goodwill impairment under IAS 36 impairment of assets. So you may be using LIBOR and switch to SONIA, which is fixed at a lower rate. So there could be an impact in terms of when you determine your value in use. However, it is worth noting that accounting estimates may not change, though, as a result of interest rate benchmark reform, as while the IBOR component of the discount rate may change, for example, it may decrease, other components may change as well. So your overall discount rate remains unchanged because you're decreasing one by the difference between LIBOR, part of it because of the decrease in LIBOR to SONIA, but then you're also factoring in the increased element as well elsewhere in that discount rate. Secondly, IFRS 13 fair value measurement. No changes have been proposed or subsequently made to the measurement and disclosure requirements that are set out in IFRS 13. The accounting estimate that is fair value may similarly be different on a longer term basis, or there may be a one-off impact as a result of interest rate benchmark reform. This may also give rise to, for example, fair value level hierarchy changes in some circumstances, given the interest or discount rate may be less observable. And the ISB thought that this was appropriate because such disclosures will provide useful information on the underlying assets and liabilities. The FRC is also not proposing to amend these areas of accounting. So, a lot to take in, and as one can see, the reform impacts accounting, but not only. It also impacts valuations and operations given differences in rates, methodologies and processes. Systems will also be changing as a result. There are tax implications as well, given it affects financial position and performance. And as my tax colleagues like to say, in most instances, the tax follows the accounting unless HMRC issues a change to legislation, which I understand that they have when it comes to interest rate benchmark reform. There is need for an overarching governance, risk and controls framework to be in place, as well as governance of the product that one offers. And with the best will in the world, errors will unfortunately be made, and customers will unfortunately not be treated fairly with associated heightened conduct risks. So, what should you be thinking about and doing? First of all, identify whether and which transactions and balances will be affected by the reform by benchmark rate, and then assess the nature and extent of the impact that the amendments will have on your transactions and balances, as well as the timing thereof, given different interbank offered rates are being reformed at different times. Have a strategy for modifying the contractual terms of financial assets and liabilities, and do so knowingly of those changes, that for which the relief proposed can be availed of, and those that cannot. In a similar vein, review recently discontinued and current hedge accounting relationships, as well as consider the designation and setup of new hedge accounting relationships that hedge benchmark rates on either a fixed to floating basis or floating to fixed basis. This is so as to be able to reinstate discontinued hedge accounting relationships where possible, which will require the maintaining of two sets of measurement bases and calculations. Decide on the approach to update and apply hedge effectiveness testing and measuring ineffectiveness for recognition thereof in profit or loss. Start preparing the disclosures that are required by the proposed amendment at a disaggregated basis so as that the information is to hand, with this including areas of critical accounting judgment, such as applying the separately identifiable 24-month requirement. And finally, your auditor will be interested in a number of things, including understanding your interbank offered rate linked exposures, as this drives the extent of the changes that will arise. How is the impact of rate and methodology changes being assessed and implemented? How are you interpreting and applying accounting requirements? The governance, process and controls that are being designed and implemented in light of the reform. How is all of this being disclosed in the financial statements? And, as I said, with the best one in the world, given the sheer complexity of all of this, there's increased likelihood of disputes and claims. So, in short, your auditors are interested in how management is responding to the impact of interest rate benchmark reform. There are resources on both interest rate benchmark reform and accounting, financial reporting, and corporate reporting on our UK and global websites. There are my and Ariel's contact details on the screen should you want to discuss this or any accounting, financial reporting, or corporate reporting matter further, as well as those of Simon Greaves, a valuations and forensic partner, and David Britton, a banking tax partner, who are members of BDO UK's interest rate benchmark reform leadership team. But may I remind you that the slides and the recording of this webinar will be circulated in a couple of days' time. And on that note, I thank you very much for your kind attention. I hope that you found this useful and that you continue to keep safe and stay well. We'll now take a few more questions. Jeremy.
Mark, thank you very much. I just got a couple that I'll put to you. Well, I'll say to you. One, I'll just give an opportunity because in the last few minutes, you've talked a little bit about things involving the auditors. Auditors would be interested in this, would be interested in that, and so on. I just wonder whether Ariel might want to say anything from the audit perspective, but having bounced him on that, I'll just ask another question while he's thinking about it, and that is, I mean, it's a more general one, stepping back. Obviously, this webinar has focused on replacement issues, and you've done stuff previously on pre-replacement issues. Is there anything you want to say very briefly about that?
Yes. I mean, in a nutshell, amendments that were issued on pre-replacement issues relate solely to hedge accounting, when LIBOR is the benchmark rate, and related to no other areas of accounting. So this enables hedge accounting not to be discontinued solely because of volatility in IBOR markets across a number of areas of hedge accounting, with these being similar to what we've been talking about today, such as group of items and risk components. And the ISB and FRC did this because of the expected increased volatility that is expected in LIBOR as interest rate benchmark reform progresses, and less banks submit LIBOR rates, and they didn't believe it was reflective of economic substance or useful for those hedge accounting relationships to be discontinued sheerly because of this volatility as markets transition. And basically, that's just to summarize, the FRC or ISB did not want this volatility to give rise to discontinuance solely because of market factors in this respect.
Okay, thanks very much. I think Lauren will go to Ariel to have a couple of words if he's been unmuted. How are we doing? Yep, Ariel.
Thank you, Jeremy. Thank you firstly also just to Jeremy for hosting us today, and for Mark for a very clear presentation. From an audit perspective, what I would say is, look, I think the rules and these changes can sound quite complex in terms of when are they changing, what are the changes, and how does it impact your business, let alone the P&L and balance sheets. What I'd say from an audit perspective is engage early with your auditors. Ideally, engage with them before you make your decisions in terms of how you're going to change, what instruments you'll change, potentially how you'll change your hedging on other areas. You know, we're in a world where, you know, auditors would much prefer to have the conversation before you make the change and try and discuss them up front rather than auditing it post the event. So engage early. And more than happy, either from a BDO or wherever your auditors are, to have an early conversation.
Okay, thanks, Ariel. I'm just checking to see whether we've got any more questions, but nothing's come in. So I think it's been a pretty full-on, high-tech, intensive webinar so far. So I think we should be able to wind up in a few minutes. And if people, I think the contact details have been provided, so if people have any follow-up questions, they know where to go. So on that note, we're coming to the end of this morning's webinar. I just want to say a few final words. I think we've managed to answer the questions that came up from the audience during the event, but thanks for those. But obviously there's scope to sort of follow up a bit further. We are recording, or we have recorded the webinar, hopefully. Don't think we need to edit out any bloopers, and we'll be finding a way to send you a link to the copy of the recording and the slides over the next few days. I think it just remains for me, first of all, to thank Mark, who's done the really hard work of presenting, and he's been up since 6 a.m. finalising it and getting it pitch perfect. So that's really, really grateful on that one. Thanks. And for Lauren, who you haven't seen, but behind the scenes has been dealing with all the technology and making sure we don't have a car crash. And then thanks to all of the members and delegates who've joined us this morning. I think we had over 60 on the call. I hope you find it useful. I know if you're like me, you'll take some time for it all to sink in and work it out. So when you get the recording and the slides, you can go through it again and again, and maybe you can even represent it to your colleagues to show that you've taken it on board. And I hope you found this useful. Thanks again.